Hello. Welcome to this edition of the InsurTech Diary. I am Lena. I work closely with Sabine Vanderlinden and Lisa Wardlaw to synthesize where the market of insurance innovation is going. Both ladies share with me their insights and I make sense of it in order to share conclusions from the research with you all. So today, I will take you through our findings and progresses in the field of dynamic underwriting, an essential topic for both insurers and reinsurers. Indeed, today insurers and reinsurers are evaluating the opportunity to evolve traditional insurance practices and business models to make them more data-friendly and more responsive. They need to do so to ensure that they can respond to customer needs faster and accurately when highly sensitive data is required within interconnected decision-making processes. Let's get started. I very much like this quote from McKinsey. The world is changing in fundamental ways, leading to dramatic shifts in the landscape of risks faced by businesses. As we all are experiencing, companies face new challenges in an increasingly uncertain world marked by catastrophic events, the digital revolution, climate change, heightened stakeholder expectations, and geopolitical risk. The digital revolution brings both opportunities and risks, including 1. Large-scale failures and security breaches with rapid consequences. 2. Reputational damage that can escalate quickly due to hyperconnectivity and social media amplification. 3. We must recognize that climate change contributes to drastically changing companies' risk-return profiles. 4. Companies must balance immediate bottom-line concerns with pressures from governments, investors, and society while addressing the rising frequency and severity of climate events and man-made disasters. While risk management maturity varies across industries, banks, oil and gas, advanced manufacturing, and pharmaceuticals generally lead the way. To navigate this unpredictable future, they must evaluate and adopt dynamic and flexible risk management strategies and practices. Still, most companies should refresh and strengthen their risk management approaches in order to prepare for the next normal. This includes emphasizing the need for dynamic risk management and outlining actions to build better for the future. This takes us to a couple of crucial definitions. These are related to static underwriting versus dynamic underwriting. Static underwriting refers to the approach used within underwriting processes that rely on historical data, standard guidelines, and manual processing activities to assess risks and determine coverage and premiums. Within the sphere of static underwriting, risk assessments are typically based on a fixed set of factors. Pricing is often determined by predetermined rate tables and established underwriting guidelines. On the other hand, dynamic underwriting refers to an adaptive and data-driven approach to conducting underwriting processing activities. The approach leverages advanced technologies, such as big data analytics, sensors, artificial intelligence, and machine learning, to assess and manage risks more effectively. This modern approach to underwriting allows insurance companies to make more accurate and informed decisions about the policies they issue, adjusting their terms and pricing in real time or near real time based on changing circumstances and evolving risk factors. These practices are most important when considering environmental change and the need to reduce and mitigate climate risk. This takes me to a comparison of static underwriting versus dynamic underwriting and the transformation which is happening right now within broking firms, insurance companies, and reinsurers. Static underwriting has several characteristics that we all must understand. First, insurers use historical data to assess risks and set premiums based on past experience and loss ratios. While this approach can be helpful in some cases, it may not accurately account for rapidly changing risk factors or emerging risks. Second, static underwriting often involves manual data entry, analysis, and decision-making, which can be time-consuming and subject to human error. These manual processes can also limit the speed and efficiency of the underwriting process. Third, insurers typically use standardized underwriting guidelines and rating factors to determine coverage and pricing. This approach may not always account for individual risk factors, leading to less personalized policies and potential mispricing. Fourth, static underwriting tends to be less adaptive and flexible when responding to changes in risk factors or market conditions. This can make it more difficult for insurers to adjust pricing or coverage quickly in response to emerging risks or new information. While static underwriting has been the traditional approach used in the insurance industry for many years, the emergence of dynamic underwriting, which leverages advanced technologies such as AI, machine learning, and big data analytics, offers a more adaptive, efficient, and accurate way to assess and manage risks. First, New data sources can provide insurers with a more comprehensive and up-to-date understanding of risks, which leads to more accurate risk assessments and pricing, ultimately improving the insurer's ability to offer competitive and fair policies to clients. These new data sources can provide real-time or near-real-time information to adapt to changing risk factors and market conditions relevant for those keen to insure emerging risks while incorporating more sophisticated predictive techniques. This can lead to better forecasting of future risks, allowing insurers to manage their risk portfolios and anticipate trends proactively. Second, dynamic underwriting allows insurers to proactively manage environmental risks by identifying potential exposures and recommending mitigation measures. This can help businesses reduce their environmental impact and lower the likelihood of costly claims. Using advanced technologies in dynamic underwriting streamline the risk assessment and decision-making process, reducing the need for manual data collection and analysis and reducing the time and effort required to assess and approve policies, resulting in operational efficiency and lower costs for insurers to speed policy approvals. Third, dynamic underwriting enables insurers to offer customized and tailored insurance policies based on specific risk profiles. This can lead to better customer satisfaction and more competitive offerings in the market. Dynamic underwriting enables insurers to offer customized coverage that addresses the specific needs of businesses facing environmental risks. This tailored approach can help insurers attract clients with unique risk profiles, such as those in industries with a high potential for environmental impact. Fourth, by incorporating real-time data and advanced analytics, dynamic underwriting allows insurers to be more agile and responsive to changes in the risk landscape, market conditions, and regulatory environment. This can help them stay ahead of the competition and maintain a strong market position. It is now essential to highlight that today, the insurance market seeks quality and accurate data sources and welcomes data providers and orchestrators to address that specific challenge. By incorporating machine learning algorithms and artificial intelligence, dynamic underwriting can reveal patterns and trends that traditional underwriting methods might miss. Dynamic forms of risk assessment and underwriting can also increase accuracy, operational efficiency, and customer experience while ensuring the market appreciates the innovations brought in by new entrants. Here are some key factors driving this change. 1. The nature of risks is constantly changing due to factors such as climate change, technological advancements, and evolving socioeconomic conditions. Dynamic underwriting enables reinsurers, insurers, and brokers to respond quickly to these changes as the risk landscape evolves, allowing them to assess better and manage emerging risks. 2. The availability of big data, advanced analytics, and machine learning have transformed how insurers can assess and manage risks. Dynamic underwriting uses these technologies to make more informed decisions, resulting in better risk management and more accurate pricing. 3. Dynamic underwriting allows for developing innovative insurance products and services that address emerging risks and meet changing customer needs. This can lead to the creation of new market opportunities and revenue streams for reinsurers, insurers, and brokers. With dynamic underwriting, insurers can provide customers with a more personalized and seamless experience. By leveraging real-time data and analytics, insurers can offer a seamless experience, more customized policies, faster approvals, and more accurate pricing, leading to higher customer satisfaction. 4. Dynamic underwriting allows for more precise and personalized premium pricing, which can be a significant competitive advantage in the market. By using advanced analytics and real-time data, insurers can offer tailored policies that better meet the needs of their customers. It is also about streamlining underwriting processes through automation and data-driven decision-making, to lead to reduced manual work, lower costs, and faster policy approvals, enhancing overall operational efficiency. Also, I want to add that as the regulatory environment becomes more complex, dynamic underwriting allows insurers to be more agile and adapt to changing rules and requirements. This can help them comply with evolving regulations and mitigate potential regulatory risks. It is time for a little bit of regulatory review. Let's consider the European Commission regulations for a few moments. It is very important for all of us to beware of the European Commission on Artificial Intelligence Directive, because it establishes a legal framework for AI usage and outlines essential requirements and obligations for businesses that are deploying AI technologies, including those used in dynamic underwriting. This in order to avoid penalties, reputational damage, and potential loss of market access. The key tenet of the AI directive is to ensure that AI systems are transparent, safe, and respect human rights and values, while being more responsive to customer needs. The AI directive calls for AI systems to be designed to minimize bias and promote fairness. Reinsurers, insurers, and brokers should ensure that their dynamic underwriting systems do not discriminate against certain groups or individuals and that they treat all customers fairly. The AI directive emphasizes the importance of transparency and explainability in AI systems. The insurance market must ensure that its dynamic underwriting systems can provide clear explanations for decisions made, especially regarding risk assessment and premium pricing. The AI directive and the GDPR impose strict requirements on how organizations handle personal data. Insurance actors must ensure their dynamic underwriting systems comply with data protection and privacy regulations, including obtaining necessary consent and safeguarding customer data. The AI directive stresses the need for appropriate governance structures and accountability mechanisms. Organizations using dynamic underwriting systems should establish clear lines of responsibility, robust risk management processes, and continuous monitoring of AI system performance. The AI directive highlights the importance of human oversight in AI-driven decision-making processes. Reinsurers, insurers, and brokers should ensure their dynamic underwriting systems are designed to allow for meaningful human intervention and review, particularly in cases where AI-driven decisions could significantly impact customers. Compliance with the AI directive can build customer and public trust. Demonstrating that an organization's dynamic underwriting systems are safe, transparent, and compliant with regulatory requirements can help foster trust in the AI-driven insurance industry. While 70% of innovations within the sustainability space still remain environmentally focused, leveraging dynamic underwriting could get us closer to considering their social innovation commitments. Insurers must incorporate social factors into their risk assessments when evaluating environmental risks, in order to consider the potential social impacts of their policies, such as community well-being, public health, and social equity. This holistic approach to risk assessment can help insurers design products that promote social innovation. Indeed, insurers can collaborate with various stakeholders, including governments, non-governmental organizations, and local communities, to better understand the social dimensions of environmental risks and develop innovative solutions to address them. Many insurers have already started actively supporting social innovation initiatives, such as investments in clean technology, sustainable infrastructure, or community resilience projects, which can help mitigate environmental risks and foster sustainable development. They also work with their customers to promote responsible business practices by offering incentives or discounts for adopting environmentally friendly measures, engaging in corporate social responsibility initiatives, or implementing sustainable supply chain management practices. So, my question to you is, which established players and new entrants are providing solutions to the market? There are many companies looking at the problem from a multitude of lenses. My thesis today will concentrate on a very few new entrant examples. These include data providers, such as Jupyter, ICI, Keros, Salient Predictions, or Zesty AI. Orchestrators, such as Maptix. Digital twins. These include as examples intelligent AI and one concern. IoT-enabled predictions, such as Previsico. Algorithmic underwriting. There are several players. These players include Artificial, Cytora, Hyperexponential, and Planck. And many more. First, the future of insurance. We'll leverage vast amounts of data from various sources, advanced analytics, and machine learning to make better informed decisions. This can result in more accurate risk assessments, better pricing, and improved risk management for insurers. Then, the future of insurance can also proactively identify and address emerging risks through real-time data analysis and continuous monitoring. This can help businesses reduce risk exposure and lower the likelihood of costly claims. Finally, the future of insurance will likely lead to the development of innovative insurance products and services that address emerging risks and meet changing customer needs. This can create new market opportunities and revenue streams for insurers. The future of insurance will allow insurers to be more agile and responsive to changes in the risk landscape, market conditions, and regulatory environment. This can help them stay ahead of the competition and maintain a strong market position. So, well, that's it for me, and thank you for your time. Do engage with us and share your views in the comment section below. It is an important topic and we look forward to interacting with you. Bye.